From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. Risk hits a pause button on the disinflation story, getting harder from here. Stocks drop incrementally. Countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, the US CPI coming in hotter than expected, jeopardizing the chances of that March rate cut. US PPI and big bank earnings will hit the tape over the next 24 hours. We begin with the big issue, inflation in the USA.
Every CPI matters.
It's an important number.
Critically important here.
Very influential in that market pricing around rates.
The Fed really has a tough job of threading a needle.
If inflation keeps falling,
it's important for the Fed to adjust their policy stance.
They will deliver those cuts, probably starting relatively soon.
The market is dead set on believing the Fed is going to ease.
Inflation is coming down.
It's going to continue to come down.
On a glide path lower.
The risk would be those rate cuts get priced out because inflation kind of turns higher.
We are not out of the woods when it comes to battling inflation.
You're going to have these fits and starts.
We were in this immaculate disinflation, but it's not going to be a straight line down.
Watch inflation and watch for how inflation behaves.
The road to heaven or hell is paved with good intentions. That's what I'm told. Let's discuss the road to disinflation. PGIM's Robert Tip, Morgan Stanley's Matt Hornbach. Gentlemen, good morning. A little bit harder than the market had expected, but does it just say to me the road to immaculate disinflation might just be a little bit bumpy, and I might need to just review my March threading of the needle for 25 basis point cut. Good morning. Matt, to you first of all.
That's exactly, good morning, and thanks for having me on. That's exactly what our economists have been looking for, is a bumpier path over the first 3 to 4 months of 2024. So we're expecting the 6-month annualized rate of core inflation to move up almost 100 basis points as we make our way through the first quarter of the year, which we do think will push back the timing of the Fed's first interest rate cut.
And, okay, that's you setting out your stall there. Let's take it across. And, Robert, in terms of this narrative, stock's a little bit lower. This is just about a re-involving and a re-engaging with the pause, isn't it?
Right. It's a re-engaging of adult mentality. The markets had a rocketing run here. Huge drop in interest rates, big pop in stock prices as we wound down the year, and people expecting these interest rate cuts, which eventually will come. We're past the peak in rates, and that's all well and good. But about that road of disinflation, I think the main thing to keep in mind is it's not a sprint. This is a marathon. And especially this time, because the Fed has laid out that they don't want to make a mistake. That by itself means they're going to have to be patient. They're going to have to wait a long time to make sure they have evidence, number one. Number two, the evidence, the data is bouncy. Every few months, the different series of inflation have had big bumps to the upside and then troughs. And so that enables people to run with their imagination and make a case that things are going to seriously reaccelerate or that they're going way below target. So I think it's a pretty smooth path. It's going to be a wide trading range. We've had a big run, and now the markets are correcting based on some short-term disappointment here.
Yeah, and one could say that is a fairly natural thing to do. Let's dig under the hood. Mike McKee has had time to read some of the pages of this inflation report. So, Mike, where do you want to go? Supercore, housing? Tell me what it is that has caught your eye on this number.
Well, let's talk about what moved. And of course, you already gave the numbers for the headline there, 0.3 on the month, 3.4, and the core 0.3 and 3.9. Increasing housing, that was the biggest change because, of course, housing has the biggest weight in the CPI, and it was up 0.5 after 0.4 the months before. Surprisingly, gasoline gain after a number of months of decline was up by 0.2. Airfares rose, and car insurance. This has been one that has been rising on a kind of steady basis over the past year. Car insurance up 1.5%. From what I'm told, it's basically people with their new EVs and things like that. It just costs more to fix that stuff when something goes wrong. Decreasing natural gas, that's going to change next week when the polar vortex hits the United States. Furniture, and oddly enough, car insurance may be more expensive, but car repair was a little bit less expensive. Let's take a look at the housing contributions here. Now, you break down housing into rent and owner's equivalent rent, and then there's a small category, lodging away from home. And you can see that the owner's equivalent rent, the purple there, is the big mover for the month, and it helped push up housing costs overall. The blue is the rent, and rent has stayed steadily high. It hasn't come down. That has surprised me. Not as much hotel price problems as we had. So where does it leave us in terms of the Fed? Well, we've seen a sort of decline over the past month or so, and you can see here a couple months worth in terms of the idea of a March rate cut. While we've seen an increase in the May rate cut. Today, you can see the boxes there show where we were beforehand and where we are now. And at this point, we have a slight increase in where the market thinks the Fed will go in March and May, but not enough to say that this has changed the game. Basically, makes the case for higher for longer. Not going to affect the Fed on January 31st. And then the question is what happens in March and what happens in May. We'll have a lot more data before that.
Okay, well, I'm looking forward to your conversation with Loretta Messer a little bit later on. But let's reflect. Just a short time ago, the New York Fed President, John Williams, weighed in on the path ahead.
My base case is that the current restrictive stance in monetary policy will continue to restore balance and bring inflation back to our 2% longer run goal. I'll expect that we will need to maintain a restrictive stance of policy for some time to fully achieve our goals.
Well, Robert Tipp and Matt Hornbeck are with me. Listening to Williams, and I listen to the New York Fed, as probably most of the bond market does, more than it listens to anybody else. I was corrected this morning by Berenberg Bank. I said the market didn't listen enough to the pushback on higher for longer. And Berenberg chastised me, and they said, no, you're misunderstanding the point. You need to understand where the new neutral rate is in a post-0% world and in a post-COVID world. So with that in mind, higher for longer, what does it mean for you, first of all, Matt?
Well, I think, certainly we need to think about what these terms mean. And, when it comes to higher for longer, we think the Fed looks at this from a real interest rate perspective, a real monetary policy stance perspective. And so in this world where you're talking about real restriction, then you need to understand where monetary policy could go based on where inflation may go. And if inflation does continue to move back towards the Fed's 2% target later this year, which is what our economists expect, then you can also expect the Fed to begin to maintain restrictive policy, but still be lowering the nominal interest rate. So higher for longer really should be viewed through a real interest rate lens as opposed to a nominal monetary policy lens.
Well, Robert, let's take that across to you, because I like what you said, which is pause, pivot, and party on. That's my kind of weekend, which is, pause, have a sleep on a Friday, and then get going again. So to do that, what number of cuts do you need to have in the pipe to deliver that party on mode? Is it the 6 that the market is baying for, or is it the 3 that you're being promised by the Fed? Not promised, indicated by the Fed.
Right. Well, I think that the pivot has happened. They have hesitated on this. They were in Matt's world, which is their world, supposedly, of the real rate, that they were going to cut nominal interest rates as inflation came down. And as you pointed out, what is neutral? And they don't know what neutral is, and they know, and they will admit they don't know. Nobody knows. But their best guess is that it's not 5.3 relative to a 3.5% inflation rate. That's a couple percent real based on one of the higher indicators of where inflation is right now. They think it's more like 0.5%, 1%, or maybe even 0. So they are very restrictive right now. So to President Williams' comment there, we need to be higher for longer in real space doesn't preclude cutting nominal rates. Cutting nominal rates keeps the vibe, the party vibe, alive in the market.
So like what you say there, which is cutting, the nuance is about the real rate, and that could allow them to do 100 basis points. That gives you 100, in theory, 100 basis points of real rates, and that could deliver a 1995 soft landing environment. Is that what I take away from this?
I think the underlying pace of growth right now is slower than the late 90s, but otherwise, by comparison, this is a better cycle in the sense that growth is very smooth. They have hiked more cautiously this time. They slowed down early enough to get good information. Last time they were hiking at an accelerating rate over a period of just under a year. And they had a pretty decent give back in economic momentum in 1995 that I think shocked them. Everything worked out fine. But there was also a lot of turbulence caused by that, starting with Mexico and the crisis at the end of 94 there. So I think this is a lot less tumultuous. I think it's very similar, though, in the sense that in 94, most of those rate hikes, they stuck. It was a very slow, moderate process after that. And right now, we have had 500 basis points of rate cuts. 500 basis points of rate hikes, right? We were down at 0. Now we're over 5. This is going to be a very slow cutting cycle by comparison. We came up, on the elevator. We're going to go down on the escalator or the stairs.
I got you.
But I think that's going to be a good environment for the market. There's going to be a lot of emotional swings here. This 4% could be kind of a central tendency, though, for the 10-year. And that could be very productive, both for returns in the long run, but also as a trading environment.
Okay, well, let's turn the talk to trade or certainly positioning. Matt, you are neutral on duration. What goes through my mind, and a lot of people on the IB have said to me, they talked about term premium. Do you think there's enough term premium? And I'm sort of answering your question on your behalf. I take it then you don't think there's enough term premium for you to take an acceptable level of duration?
Well, on a tactical investment horizon, yes, we think that's right. But on a more strategic horizon, we think there's plenty of term premium in the bond market today. Our tactical neutral stance is a stance. Oftentimes people think about a neutral position as not taking risk. I mean, there's an opportunity cost to every decision that you make in markets, and being on the sidelines does present a cost. So we are taking a view to be tactically neutral. But the reason for that is not because there's not enough term premium in the market. The reason is because we do expect a little bump up in inflation, and so we would be looking to buy any rise in yields as we make our way through the next couple of months.
Robert, let me take that across to you. You're still in the strategic buy zone for bonds. I mean, are you happy to pick up 4%, or do you want to see a further backup in yield, before you attempt it in on duration?
Well, I think the market is at a healthy point here, and to that, Matt is neutral duration, and the posture here that makes a lot of sense is to be relatively neutral, but it's going to be a trading range environment. And I think in Morgan Stanley research and for us, there are a lot of opportunities inside the yield curve here in terms of shape for adding value through roll down strategies and expecting changes in the slope of the curve. On the term structure point, I think that we have been in a world for about the last 5 years that we're going to stay in, where the investors that are really driving the market have a long-term perspective. And so in that sense, this will be, I believe, like the 2019 cycle, where after the rate hikes of 2018, after that ended, the curve rallied a good deal and then maintained a pretty tight relationship between the expected Fed funds rate and the 10-year. And we're down at that kind of a relationship right now. So I think the expectation that the Fed's going to cut a couple hundred interest rates, 10 years are around 4%, centered around that forward expectation for the Fed. I think we're going to be range bound around that kind of a relationship. That's going to be enough term structure premium or slope, really, to put it more plainly, for this cycle.
Okay. Hold those thoughts, gentlemen. We'll be back. Robert Tipp and Matt Hornbach, my guests this morning, on the very latest CPI data. Let's look under the hood, look at the stocks that are moving. Abigail Doolittle is side by side with me here.
Well, Manus, futures are pointing down slightly after that somewhat hot CPI print for the month of December. Starting off with the shares of Tesla. Right now, they are at pre-market lows or thereabouts, down 1.4% on that warm CPI print. They also just told their staff that all U.S. production workers are getting a pay raise. Bank of America down about 1% as yields and the yield curves are higher. One of the big banks, of course, is reporting tomorrow, Bank of America, along with JP Morgan and Citigroup. Maybe some nerves into that. But take a look at Coinbase, Manus, up 4.6%. This, of course, after that landmark decision by the SEC to allow ETFs to directly buy Bitcoin. It's being called by many a significant milestone.
Okay, Abby, we'll see you a little bit later on. We'll break down some of those sectors. Coming up on the show, GOP candidates, they square off in Iowa.
It's time we have an accountant in the White House. We have to have someone that respects taxpayer dollars.
We don't need an accountant in the White House. We need a leader in the White House, and that's what I would bring.
Nikki Haley and Ron DeSantis going on the attack before the Iowa caucuses. That conversation next on Bloomberg.
It's time we have an accountant in the White House. We have to have someone that respects taxpayer dollars.
We don't need an accountant in the White House. We need a leader in the White House, and that's what I would bring.
If he can't handle the financial parts of a campaign, how's he going to handle the economy when it comes to the White House?
The American dream is slipping away. People are working hard. They're getting the most out of their God-given ability. They're doing everything right, and they're falling further and further behind.
We need to start cutting spending in D.C. We have to go back to pre-COVID levels. That's why I'll veto any spending bill that doesn't take us back to pre-COVID levels.
Here's the thing. We need to fly a flag of bold colors, carrying the banner of putting the American people first, not the pale pastels of the warmed-over corporatism of people like Nikki Haley.
GOP candidates, Ron DeSantis, Nikki Haley, battling for the second place in the Iowa debate, slamming one another's economic policies, taking shots at Bidenomics. This CPI number coming in just a smidge hotter than estimated, putting the pressure on the president as he pushes his economic agenda amid worsening poll numbers. You've got the latest CBS YouGov poll showing 64% of Americans disapprove of his handling of the economy. Bloomberg's Katie Lyons joins me now for her assessment of the chunk-biting debate. Kaylee, good morning.
Good morning, Manus. I mean, Nikki Haley and Ron DeSantis spent more time throwing barbs at each other than they did, frankly, at the current president or the former one who remains the frontrunner in the GOP primary. But they did get into the issue of the economy very much so, both pointing to higher inflation, putting pressure on American families and voters, but also on the high debt levels. Both of them did point out in their few swings at Trump the idea that he added $8 trillion to the deficit. And as we just heard there, Nikki Haley, when asked what she would do to address the economy, said she would cut levels of spending and borrowing, would veto any bill that didn't bring spending below pre-COVID levels. Also said she would get rid of the federal gas and diesel tax. While Ron DeSantis talked about the idea of a flat tax across the board, also unleashing American energy production in order to get inflation down. But the fact remains, man, is that both of these two are competing for second place right now, as Trump far and away is the frontrunner in Iowa, which of course comes up on Monday. And generally right now, and they have to get through him and to get to an actual general election with President Biden as the Democratic nominee. Now, on the subject of President Biden, the numbers today heading in the wrong direction for this administration, which has been touting inflation and price pressures heading lower. And even as they have been heading in what has been consistently the right direction, he is struggling to get actual credit for that in polling. You mentioned just the latest poll, but it is consistent across the board that he really struggles with approval on the economy front, which is why the president has increasingly turned his messaging from Bidenomics more so to the threat of democracy that he says former President Trump presents to the American people. That really is how he's been leaning. We haven't yet gotten a statement out of the White House on today's figures, but I would imagine they're still going to stress that prices are lower than they were or price pressures rather, are coming down compared to where they were a year or two ago, Manus.
Yeah, well, it's certainly about the cost of the basket when you go into the store, Kaylee, and the gas at the pump. Kaylee Lyons, thank you very much. Robert Tipp and Matt Hornbach are my guests this morning. Gentlemen, I'm not going to ask you what you thought of the debate or who you think is going to be in the White House, but the way the odds look at the moment, Trump is out front ahead of his pack and his peers. from a market's perspective, how early will we begin to see? If Trump is on the ticket, what will that mean for the fiscal narrative to the bond market? Matt, to you first.
Well, as they say, 2 weeks is a lifetime in politics. So I don't think that markets are going to be particularly concerned about who ends up being the nominee for the Republican Party until it's actually in hand. But nevertheless, I do think that as we make our way later into the year, there is going to be focus on how the upcoming election and, importantly, the uncertainty around the election outcome, whatever it may be, could impact the confidence of consumers and the business investment plans of corporate America. You know, generally speaking, when we go into a very uncertain election cycle, you typically see businesses pull back, consumers pull back. They wait until they have clarity about the outcome of the election. And then we see a boost to activity after the election is out of the way and the results are known. So I do think that the election does present some interesting risks to the economy as we get closer to the election day itself. But I do think people will be on the more patient side until they have clarity.
Robert, let's cast it over to you. I mean, should I be more preoccupied by supply? I mean, the market has taken supply quite well this week in the United States on the investment grade front, likewise in Europe. Should I be more preoccupied about supply and the deficit now this year than what can come with whoever the next incumbent is?
I think the supply fear will be linked to who is going to be the next president.
Right.
And I'm not a politician. I'm not a political pundit. I'm not looking to tell you what should happen, but just based on what has happened, if we end up with President Biden in the White House, it looks like that would be more of a stasis in terms of the amount of supply out there. In other words, it stays massive. But when Trump was in 2016, after the election, there was a sell-off in the bond market on expectations for fiscal stimulus. That was quite substantial. There was a reprieve while nothing happened, and then another sell-off.
I got you.
So I think it could be a bearish situation there.
Okay, we've got a long way to run between now and the election. Don't worry, you'll get these questions again. Robert Tipp, Matt Hornback, and it will evolve. Coming up, we'll give you your morning calls right here on Bloomberg. Your morning calls. First up, Jefferies upgrades American Airlines to a buy, expecting the shares to benefit from their upcoming investor day. Up next, Goldman downgrading Lyft to neutral, seeing a more balanced risk reward. And finally, Oppenheimer upgrades MasterCard to outperform Go Shopping. The expectations are for an earnings per share growth and acceleration. Coming up, Bird's David George and Nuveen's Sarah Malik join me after the opening bell on Bloomberg. We're just about 30 seconds away from the opening of the cash market. We've managed to do an hour of prevarication across these markets. We've managed to swing it back into the green by 1% on the S&P 500. You might have a hotter, technically hotter CPI, but it doesn't assuage the market from taking a little bit of risk. There's the bell. Markets are flush, and we have a flat euro dollar down by 1%. Yield spiked a little bit higher, but nothing too dramatic to provoke a repricing of a March rate cutting, the initiation of March as a rate cutting cycle. Bonds trade at 402. That is rich enough for some people to step in and buy the bonds here. My last set of guests thought bond market could back up to 425 and a little bit beyond. Crude rallies 2.5%. Again, a reassertion of geopolitical risk in the Red Sea and attacks from the Houthis. What will the coalition of the willing do to protect the maritime interests in the Red Sea and 12% of global trade? One stock to watch, KB Home. The share is under pressure after reporting a decline in the average selling prices. Abigail Doolittle has the detail. Abby.
Hey, Manus. Well, this stock is under pressure, down more than 4%, the worst day going back to December 15th, so almost in a month. So they put up a big beat, but beneath the surface, not so great. As you mentioned, prices declined on a year-over-year basis. That means that even though adjusted earnings of $1.85 beat, they were down on a year-over-year basis by 32%. Revenues of $1.67 billion, down by 14% on a year-over-year basis. So for a stock that is up more than 150% out of the 2022 lows, it's just not enough. One bright spot, though, is the fact that they are seeing orders for the first 5 weeks of the first quarter of 2024. Well, they are higher, so perhaps things will turn around here. But again, the stock into today had been up 150%, price to perfection. Investors didn't quite get it out of that quarter.
Okay, I'll take a price drop in any property at the moment in this market. Abby, thank you very much. Let's turn it over to M&A. Chesapeake Energy agreeing to buy its rival, Southwestern. It's an all-stock deal worth roughly $7.4 billion. The timing of it, Simone Foxman can give us the details. Simone.
Yeah, Manus, the price there about $6.69 a share for Southwestern. Note that Southwestern closed yesterday's trading at $6.89 a share. For Chesapeake, this furthers their ambitions in natural gas, specifically as oil and gas majors try and consolidate. Expands their holdings in two key drilling regions, the Marcellus in Appalachia, as well as the Haynesville Basin. That's in Louisiana and East Texas. And especially that last one, this gives Chesapeake a little bit better access to those export terminals that are on the Gulf of Mexico. Ahead of this announcement, because it had been something that many had been watching since the first deal, the potential deal was first reported in October, Stifel calling this the highest quality natural gas equity, but notably not moving too much on either end because this deal had largely been known about.
Yeah, well, there's certainly a few other deals have gone through in the oil and gas sector. So what 2024 brings us, let's wait and see. Simone, thank you very much for the details. Let's turn our attention to the automakers. Tesla, never far from the news belt. Workers at the California plant will get pay increases across the U.S. factories. Katie Greifeld has the details. A generous boss. Katie.
We don't know how much of a pay increase, but all production associates, material handlers, and quality inspectors at Tesla's Fremont, California factory are getting a, quote, market adjustment pay increase. And with that boost, Tesla becomes the latest non-union automaker to raise pay in the months since the UAW's win over the big three automakers. Now, this factory in California, it employs more than 20,000 workers. And Bloomberg News has reported that employees at that plant have formed a UAW organizing committee. Tesla perhaps responding to that pressure, even though CEO Elon Musk has long been critical of the UAW and unions in general. Obviously, a different tune today. Manus and shares down about 2%.
Okay, there we go, 229.36. Turn over to the financials now. It's going to be a huge day tomorrow on the results. But Citigroup already stating that they will set aside $1.5 billion to cover the risks on their exposure to Argentina and to Russia. Now, this comes ahead of tomorrow's quarterly results. Shanali Basak is with me on the details. Getting out early, giving us the bad news. It's a lovely setup for Friday. Shanali, good morning.
Good morning. And we know that Citigroup has a lot of complicated things to explain to investors, including what their turnaround story looks like going into this year. As you said, they are going to be setting aside $1.3 billion in a reserve build. They are being impacted by currency fluctuations, extreme fluctuations in Argentina, plus geopolitical risks in Russia. Remember, these are markets that they have been exiting. And as we look forward to Citigroup's story, remember, they also are pursuing a job-cutting plan and eliminating layers of management. By announcing this reserve build now, they can go ahead and tell investors what the plan is for this year and how they expect to expand revenue in addition to places outside they're already succeeding. They have been showing success at places like their treasury and trade solutions businesses. Now, can they bring up returns, Manus, to their investment bank and their markets businesses as well to bring returns closer in line to other Wall Street firms? Investors will also be looking at Citigroup's ability to manage expenses as they go through this turnaround story. Analysts calling this a pivotal year for Citigroup, where the shares have lagged its peers for the last 3 to 5 years.
Or to quote Mike Mayo, get ready for a metamorphosis. Sonali, thank you very much. Let's stick with the banks. Birds, David George joins me now for his outlook for the year. And this is what he says. We have a moderately constructive view towards banks as we enter 2024. We don't see the same upside today as we did during the sell-offs of 2023. Good to see you, David, with me. Can we just kick off with Jane Fraser's strategy, which is the big upfront reserve built for Argentina and Russia? The building narrative is this stock could triple in price from Mike Mayo. Would you be as bold as that on backing Jane Fraser at Citi?
Good morning. Thanks for having me, Manus. Unfortunately, I can't comment on Citi. I don't cover the stock, so I can't give you a whole lot of color there, but certainly happy to talk about banks as we get into earnings season. We're of the view that there's a fairly high bar going into earnings. The banks have had a very big move, 30% plus in the last 6 weeks, and we feel like the upside here is not nearly as significant from our perspective, and the bar from an earnings perspective is as high as we've seen in about a year or so. So will be fascinating to see how results come in starting tomorrow morning.
I mean, that's look, that sort of sets the bar low for expectations. I look at the big issues. I've got NIMs, I've got credit quality on commercial property, and I've got excess reserves. So I just want to break it down. What are you most nervous about in this reporting season?
Probably the net interest income outlook over the next couple of quarters. Loan growth continues to be pretty soft, and you continue to see a timing mismatch from funding costs going up at a faster rate than banks have been able to reprice their assets. So the combination of those two things we think could create a little bit of bumpiness over the next quarter or two from an expectation perspective. But from a credit quality standpoint, we feel pretty good about where we sit. And clearly there's been a lot of gnashing of teeth around this commercial real estate and office issue. We think that that's largely reserved for by a lot of these banks, so we're not particularly concerned about that. But it's really a function of revenue growth from here is, I think, what we're certainly going to be focused on.
I mean, I'm looking at some of your favorites out there, and it's Citizens, it's Commercia, it's Huntington. So again, I saw some hedges go through on these more regional bank players. Why are you pitching these names on the favorites list at the moment?
Well, from our standpoint, the large cap part of the market has moved much faster and much more significant than the regional banks. And typically, the regionals trade at a premium to the money centers or the mega caps, and that really has flipped over the last 6 to 18 months. And we think that the opportunity set is the best in that regional bank group, just simply because the valuation construct and setup from our standpoint, at least, looks much more attractive. You've got several stocks, Manus, trading at 7-8 times earnings, whereas the money center banks like a JP Morgan, for example, is trading at 11 times. So it's really just a risk-reward trade-off and finding a preference for smaller regionals than the money centers here.
Yeah, the blood is rich at the top. They say it's royal almost at the top there at JP Morgan. We've got $145 billion of excess capital. Now, it took greater minds than me to come up with that. That's Bloomberg Intelligence. So we have a collective excess capital in 8 USA systemic banks. JP Morgan leads the overall. But the question that it begs is, do you expect a significant payout dividend buyback 2024 across the sector? Is that what's going to perhaps help put a floor under some of this?
Yeah, in a word, Manus, no. Unfortunately, from our perspective, 2024 is going to be a year of capital building for the banking industry, and that fortunately is going to happen relatively quickly, we think, with limited loan demand at the moment and pretty good inherent profitability. We think the group is going to really across the board, big, small, and mid-size. 2024 is a significant capital building year, and I think 2025 has the potential for not only significant buybacks and potentially some small dividend increases. We also think that you're going to see a fairly significant improvement in net interest margin, net interest income in 2025 as, again, we get that kind of catch up on the asset side, loan repricing, securities repricing, et cetera, have a very positive impact on profitability next year in 2025.
Okay, so I'm wrong on some of the most basic assumptions then. But look, there you go. We've got KBW. It did get a little bit of a boost into the back end of 2023. David, you set a formidable table for us to keep an eye on. David George there on the banks. Nuveen's Sarah Malik is with me, weighing in on the upcoming earnings season. Now, this is it. The bar is higher than the past quarters. However, a weaker dollar, a stronger economy may lead to an earnings per share upside versus consensus. Sarah, good to have you with me. I mean, everybody's pitching in with their view on earnings season for this quarter. So where do you think the strength will come in the earnings per share?
Well, Manus, it's good to see you. You know, markets started off this year with a bit of a hangover, and I think there's going to be three reasons why we're starting to see a change in that. One is CPI, second is earnings seasons, and third is the conference circuit. So starting with earnings, yes, we are seeing about 3% consensus earnings growth year over year, but where we think there could be upside is that consensus is expecting margins to contract by almost 100 basis points. I think that's too pessimistic. So I think earnings season could be a positive catalyst for the market. Now, switching back to CPI, the story is not as rosy here, especially with Supercore, which is what the Fed focuses on. That has proven to be very sticky because of wage inflation. We also saw goods inflation coming in less negative, and the surprise of used car prices increasing again. So I think inflation, however, today gives one more point to the bears. And then, of course, the conference circuit, CES, giving a bit of wind back into the sales of technology stocks, and the JP Morgan Healthcare Conference, where people are looking for, is there going to be more M&A in biotech and also in the med tech business? Also, those stocks also are getting covered because there's some optimism there.
Well, let's just break part of it down. Many people, look, the market is pricing in 5/6. The CPI and the Supercore behaved itself today. Maybe it's the PCE that will redefine the narrative on rate cuts and risk in the next couple of weeks. But you say that we can expect an elongated rate pause. Translate that for me. And therefore, does that undermine? The natural question is the 6 cuts that are baked in. And what does that do for risk for you?
One of the key questions this year is, what will the Fed do? Today's CPI number tells you likely not 6 rate cuts, with the first one starting in March of 2024. CPI coming in hotter than expected. Our view has been that what we're going to see is more of an elongated pause. The Fed is not going to rush to start implementing those rate cuts. I think they start later this year, and the Fed's goal will be not to really tighten or loosen monetary policy, but to keep real rates stable. So they'll somewhat cut rates maybe 3 to 4 times in order to keep real rates stable because inflation has been declining. But I don't see them going so far as to loosen policy. And that's what you get with 6 rate cuts. That's why we're coming in under on that. We see less rate cuts, and we see them starting later because the Fed needs more data around inflation easing. The other side of that is the economy. The economy is strong. So the Fed is not in a rush to cut rates because we're in a recession. The economy has been strong enough so we can keep rates stable for a while.
I like what you say. We started 2024 with a hangover, which leaves me with many choices of what to eat on the morning after the night before, which is either defensive play or run a mile from Magnificent 7. You know, Mag 7 will turn into Lag 7, or go for breath. So those are your 3 hangover cures. Tell me which one you want to pick.
Yeah, I mean, my personal one is probably more greasy food. But when it comes to stocks, exactly, in a world where we do worry that the economy may start to slow eventually this year, we're becoming a little bit more defensive. Also, market valuations coming into this year at quite a premium given the 2023 returns. So defensive areas like infrastructure, which is more resilient when the economy slows. Dividend growers, for those looking to get their cash off the sidelines back into equities. Dividend growers pay you some income because these companies increase their dividends over time, and they tend to perform a little bit better during periods of downside volatility. We also like fixed income, higher quality like investment grade, and municipal bonds, where the fundamentals are very strong for that sector still.
David George just blew my tires out on banks. I was sort of like bullish on buybacks. I was bullish on dividends. I was sort of almost bullish on net interest income, but that got quashed. In a few short words, would you be long financials into 2024? 30 seconds. Wrap it up for me.
I think it's tough on financials here. We're coming in with positive sentiment due to the expectation for lower rates, but they had a strong run in 2023 at the end of the year. There's still regulatory issues with higher capital requirements. You have to be selective. I like the regional banks, also Wells Fargo, for the turnaround story.
You can give him a call. He's got some nice calls on the regional banks there. You can do a trade. Sarah Malik, thank you very much. Rounding out and setting the agenda for 24. Coming up, the first ever Bitcoin ETF. It starts trading today. That conversation is next.
We think that the Fed probably won't start cutting rates until around June. And the key thing will be the course of inflation. The good news is that core inflation is still slowing, but the Fed also cares about the headline. And certainly when we look in the core, if home prices are still rising month on month, that doesn't bode well for year on year.
Dana Peterson there at the conference board weighing in on U.S. inflation speeding up at the close of 2023 challenges the market's expectations that the Federal Reserve will soon start cutting their rates in March. Turning to crypto, investors rejoicing after the SEC approved the first ever Bitcoin spot ETF. It was a rare move by the agency after a decade of opposition. The chair, Gary Gensler, wrote this: Bitcoin is primarily a speculative, volatile asset that's also used for illicit activity. While we approve the listing and the trading of certain spot Bitcoin ETP shares today, we did not approve or endorse Bitcoin. Trading begins today. Katie Greifeld joins me now. I mean, that's a heck of a non-endorsement by Gensler, isn't it?
Yeah, kicking and screaming, but it finally happened, Manus. The SEC did give its blessing to those U.S.-listed spot Bitcoin ETFs. About 10 or so started trading at 9:30 a.m. today, a cool 19 minutes ago. And like you said, this comes after more than a decade since the first spot Bitcoin ETF application was filed back in 2013 by the Winklevoss twins. Now, as you read from SEC Chair Gary Gensler, this was not an endorsement of Bitcoin. And he also wrote that investors should remain cautious about the myriad risks associated with Bitcoin. So again, not exactly ringing there. But on the other side of that, you did have Commissioner Hester Peirce on the other side telling Bloomberg TV yesterday that while she was delighted with the result, there are still pieces of it to go. But this is a big milestone nonetheless. And despite that difference in opinion between the chair and some of the commissioners, this ultimately came down to a 3-2 vote of the SEC commissioners, and Gary Gensler was the deciding vote in favor. Now, with these funds finally out the door, the question becomes, does the world really need 10 or 11 U.S.-listed spot Bitcoin ETFs? But of course, that story will take a little while to play out, Manus.
Well, it depends. They're going for the jugular on the fees, aren't they? Katie, thank you very much. Wrapping it up there. Meanwhile, crypto stocks, they're getting a fresh boost from the Bitcoin ETF approval. Alex Semenova joins me with more.
Hey, Manus, good morning. Crypto equities are, of course, big beneficiaries here, getting a fresh momentum boost after an already incredible run-up to this decision last year. Then crypto exchanges, crypto miners, all extending the gravity-defying gains that they saw back in 2023. Coinbase, the crypto equity poster child, and miners like CleanSpark and Marathon Digital Holdings are some of the names moving higher this morning after an incredible run. Coinbase, for example, last year gained 250%, now building on that monster advance. Now, always interesting to see some of the Wall Street commentary. Analysts at Deutsche Bank said that this decision marks a significant milestone. They see Bitcoin gaining through the end of the year. Of course, a positive for these crypto adjacent names. However, they did emphasize not to conflate price gains with broader predictions of crypto overtaking traditional finance. And this momentum ETF approval by the SEC is, of course, bolstering some of those crypto names. Keep an eye on names like Becht, Cypher Mining, Riot Platforms, and TeraWulf as well. Manus.
Okay, big day for crypto. Alex, thank you very much. And tune in for our interview with the Grayscale CEO. That is at 1 p.m. Eastern Time on a special edition of Bloomberg Crypto. Some more price action for you in the sectors. Let's get to Abigail Doolittle. Abby, what have you got?
It's interesting sector action today, Manus, because right now we have the S&P 500 down by about 0.1%. But the sector action, I would say, is neutral to possibly even risk on. I say that because the top sectors are communication services and tech. So basically those mega cap tech sectors, energy slightly higher. To the downside, utilities, that's a defensive sector. So in a way, there's a risk on tone to that. And there are other defensive sectors that are down. One big story in the day, tech's gain at this point is pretty small. Microsoft up about 0.75%. Apple down about 0.75%. Manus, right now we have Microsoft taking out Apple from a market cap standpoint, both right about 2.8 trillion above there, closer to 2.9. Microsoft ever so slightly above. And I think, I'm checking right now, I think that Microsoft is actually putting in a new record high. I'm looking for that. Yes, Microsoft at a record high.
There you go, record after record. Who said that Mag 7 was done? Abigail, thank you very much. Coming up, the market moving events for your trading day. It is your Trader's Diary. Let's get you up to speed with your trading diary. But before we do that, I want to show you Bitcoin up 6%. You're looking at this cryptocurrency lit up. You're looking at the highest level since the latter part of 2021 for the market. in terms of the ETF being agreed upon. Your trading diary, let's set your agenda for you. We've got the Cleveland Fed President Loretta Master, the Richmond Fed President Tom Barkin, they speak later today. Plus, a little bit more of a bond auction. Can you take some more? 21 billion bucks of 30-year. If you want duration, it's on the slate today. Friday, we're building up to the bank earnings, kicking off ahead of the opening bell. Plus, we will give you the PPI, post-CPI. Is there anything there that we can tell you? Supercore CPI, fairly well behaved. Finally, Neil Kashkari will speak. That is a roster of Fed speak for us to digest in the morning. I can tell you Bitcoin is the highest since the 27th of December, 2021, up 6% on the day. Is there more fuel in the tank for crypto? That's it for Countdown to the Open. I'm Manus Cranny. This is Bloomberg.